Have you ever wondered how the stock market works? It's not just a chaotic jumble of numbers and arrows on a screen. Rather, the stock market is a dynamic platform where shares of publicly traded companies are bought and sold. Picture it as a bustling marketplace, but instead of fruits and vegetables, it's stocks that are up for grabs. Companies list their stocks on this market to raise capital, the funds they need to grow and expand their operations. On the flip side, we have investors like you and me who buy these stocks. We do this with the hope of making money either through capital appreciation, which is when the price of the stock goes up, or by earning dividends, which is a share of the company's profits. So the stock market is more than just a marketplace, it's a hub of economic activity. Now that we know what the stock market is, let's get to know the stars of the show, the stocks. Stocks are the slices of the corporate pie, and they come in flavors like common and preferred. Common stocks give you voting rights in the company, while preferred stocks don't. But preferred stocks get you paid dividends first. Stocks also come in sizes, large cap, mid cap, and small cap, representing the total market value of a company's shares. Remember, each type of stock carries its own set of features and risks. So you might be wondering, how do people make money in the stock market? Well, it's not as mysterious as it may seem. There are two main ways investors make money from stocks: capital appreciation and dividends. Let's break this down. First, we have capital appreciation. This is the concept of buying low and selling high. You purchase a stock at a certain price, and if the company does well, the stock's price increases. When you sell your shares for more than you paid, that's capital appreciation. Then we have dividends. Some companies distribute a portion of their earnings back to their shareholders in the form of dividends. If you own shares in a company that pays dividends, you'll receive a bit of the company's profits for each share you own. But here's the kicker: the stock market isn't a guaranteed money tree. While the potential for high returns is enticing, one must also be prepared for possible losses. Remember, investing always carries some level of risk. Speaking of losses, let's talk about the risks involved in the stock market. The market is like a roller coaster, subject to volatility, where prices can fluctuate wildly in short periods. There's also no ironclad guarantee of returns, and the possibility of losing your initial investment is as real as it gets. The stock market can be a rewarding venture, but it's not without its perils. It's important to understand these risks before diving into the world of stock investing. So how can we mitigate these risks? One word: diversification. Diversification is a strategy that can help protect your investments from major market downturns. It's essentially the financial equivalent of not putting all your eggs in one basket. Instead of investing all your money in one stock or sector, you spread it across a variety of different investments. This could mean investing in different sectors like technology, healthcare, or consumer goods. Or it could mean investing in different types of assets like stocks, bonds, or real estate. By spreading your investments, you're less likely to experience significant losses if one sector or asset class performs poorly. Think of it like this: if you're standing on one leg and you stumble, you're likely to fall. But if you're standing on two legs, you have a better chance of catching yourself and staying upright. That's the power of diversification. Diversification can help smoothen out the bumps on the road to financial growth. So there you have it, a brief overview of the stock market. We've touched on the basics, from understanding the market itself, the various types of stocks, how to make money, the risks involved, and the importance of diversification. But we're just getting started. Stay tuned for our next video, where we'll dive into preparing to invest, choosing the right brokerage account, understanding stock research, and making your first investment. Until then, happy investing.